There's nothing that First Property Group does that's unique, but what we do is focus principally on income. By focusing on income and the level of income one can earn on a commercial property when we invest in it, we've been able to keep ourselves safe through the various cycles that we've been through over the last 20 years. When income levels on properties have dropped because values have risen, we've sold. And when income levels have increased because values have dropped, we've bought. And just following that very simple rule, we've done pretty well. Income remains relevant in property investment, whatever the environment. And it is, I suppose, particularly relevant at the moment in view of the fact that interest rates are so low. You can hardly earn anything if you were to put your money in a bank. But you can, on good commercial property, good secondary commercial property, invest at yields of around 6.5%, 7%, on occasion 8%. And that is shooting the lights out when you think that bank base rates are down at 0.25%. Well, undoubtedly the biggest challenge has been the credit crunch. There have been all sorts of potholes, none of which are immediately obvious when you think a credit crunch is coming your way. Actually, we had a good economic run during the credit crunch, but because other people with whom we traded were having trouble, and this is the domino effect, I suppose, we had to dance around various little explosions which we really wouldn't have been able to predict as we went through the 7-8 years after 2008. So that has tested us. The most successful investment policy that we adopted in 2013, buying vacant office blocks at a time when office blocks were completely shunned by the market. And we did that knowing that the government was going to introduce permitted development rights for the conversion of offices to residential use. And we moved very quickly, miles ahead of the market. And that fund, we raised a £40 million fund in 2013. We bought about 10 properties and it produced an unleveraged internal rate of return of 98%. And that's going to be hard to beat. Well, we think the market's very interesting at the moment. Depending on where you sit on the Brexit debate, you're either pro the UK economy or nervous of it. But the nervous aspect has created opportunities for us. The institutions in particular are nervous at the moment, and we've been able to move up the lot size scale from our usual purchase of around a £5 million average lot size to 20–25 million. And we're also targeting the office market, not so much for permitted development rights because the low-hanging fruit there have gone, but because vacant office blocks have now been converted to residential use. The remaining office blocks are much more valuable. So those are the two areas that we're really focusing on.